I'm Ryan Iverson, and this is the Investor Breakout Weekly Insight. Let's talk about what happened this week. What if Canada's next major pipeline is built for geopolitics as much as profit? A new West Coast pipeline is back on the table, but this time the conversation isn't about oil, it's about sovereignty. Alberta is expected to formally submit its proposal for a new pipeline to Canada's Pacific coast, with the goal of opening new export markets in Asia by the early 2030s. And for the first time in years, Ottawa appears to be on board. The federal government has identified the project as one of national interest. Officials say it would help diversify Canada's energy exports beyond the United States while strengthening the country's long-term economic and energy security. Why now? Recent disruptions in the Middle East expose just how vulnerable global energy supply chains can be. Canada sees an opportunity to become a more reliable supplier. The challenge is getting there. No private company has yet stepped forward to build the pipeline, despite political support from both Alberta and Ottawa. Investors also remember projects like Northern Gateway and Energy East, where billions were spent before the projects were canceled. So while the political momentum is building, the commercial path remains uncertain. The question now is whether Canada has the resources. It's whether the country has the resolve to bring a project like this across the finish line. Even the world's biggest sporting event isn't immune to the laws of supply and demand. The FIFA World Cup is kicking off more than soccer. It's becoming a real-time lesson in economics. As Canada co-hosts the world's biggest sporting event, many expected packed hotels, sold-out restaurants, and a tourism boom. Instead, some host cities are seeing the opposite. In Vancouver, hotel bookings are reportedly down 20% compared to the same period last year. Why? Because even for the World Cup, there's a price people won't pay. Hotel rates have surged. Secondary market tickets are fetching around $2,000 a piece, and many fans are choosing to skip the stadium, opting for fan festivals and public viewing events instead. Demand doesn't rise forever. Eventually, consumers push back. The World Cup will still deliver unforgettable moments, but for investors, one of the biggest stories may be happening off the pitch. When prices outrun value, markets have a way of correcting themselves. What happens when a junior miner builds two value drivers instead of one? After being recognized as a top 5 pick at the 2026 CEM Bermuda Capital Event, Forge Resources Corp is quickly attracting investor attention. And one of the reasons is that it isn't a typical junior mining story. Forge, or FRG on the CSE, is building two potential value drivers at the same time. In Colombia, the company is advancing its fully permitted La Estrella coal project towards production. The goal is simple: generate cash flow. That cash flow could eventually help fund exploration without relying entirely on new equity financings. At the same time, Forge is advancing its Alada Gold copper project in the Yukon. Located in the Dawson Range Gold Belt, just 45 kilometers from Western Copper and Gold's Casino deposit, Alada has already returned gold mineralization in all 15 drill holes, completed between 2023 and 2025, across an emerging 4-kilometer target area. The company recently completed a $6 million financing to accelerate both projects. Part of that capital is funding a 5,000-meter drill program at Alada, where management is now targeting areas with even greater copper potential. It's a strategy investors don't often see. Near-term cash flow from one asset, long-term discovery potential from another. And with major catalysts expected from both Colombia and the Yukon over the coming months, Forge is a company investors will be watching closely. Read the full Forge Resources editorial spotlight now at investorbreakout.com. I'm Ryan Iverson, and we'll see you next week.